Okay, welcome back to the third video on monetary policy, and here we are going to discuss the transmission effects theory. And the theory simply says that any change in interest rates, any change in money supply, is going to have a great impact on not just the money markets, but the bond market, which will translate into an effect on the capital on the capital goods market. Now, please keep in mind the capital goods market is the market which is frequented not by the ordinary consumer but by businesses. So that is the investment market. Okay, so that's the market that's going to feel the impact, and ultimately that is going to have an impact on the goods market. So I think that this particular diagram, this really illustrates this transmission really well. Okay, and in order to understand this, now please bring to mind the knowledge of the bond market and the money market and the monetary policy, which we have already done in the previous video. So you can uh, definitely refer to those if you want to um, revise that. But as we already said, that there is a definite relationship between the money market and the market for uh, secondary securities, also called the bond market, in the developed economies. This is not something that you will find happening in the underdeveloped countries. So if you are in Pakistan, or you are in Kenya, or you are in South Africa, maybe this will not apply there. But in the developed countries, in the UK and the US and in Europe, this is a very very important relationship to understand. So what is going to happen? We are going to see that there is a definite interaction between the money market and the bond market. When the money supply falls, let's say the government is uh, pursuing a contractionary policy, money supply falls. Okay, now when the money supply falls, now previously when we were discussing the bond markets, we were talking about the government selling the bond and raise the money. Keep that in mind, that now the government has sold the bonds, and the bonds are in the possession of the people. They are in the possession of the lenders. Keep that in mind. Okay, and now the government reduces the money supply. The central bank reduces the money supply. So when the central bank reduces the money supply, there is going to be a crunch, a liquidity crunch. There's going to be shortage of money. There's going to be shortage of cash, liquid assets, as we call them. Okay, we will not use the word cash. Sorry, we will use the word liquid assets. Liquidity will be reduced. The money supply is reduced. So what's going to happen now? This will have a mirror effect on the bond market. Okay, people are short of money, so what are they going to do? They are going to take the bonds that they had bought from the government. They're going to sell the bonds to take out the money. They want money, so they are going to sell the bonds, and they will be reluctant to buy the extra bonds that the government is now issuing. So what's going to happen in the bond market? In the bond market, there is going to be an increase in supply of bonds. People want to sell more bonds. Every time there is an increase in supply of any asset, anything, there's going to be a fall in the value of that particular asset. So the value of the bond falls. Okay, the value of the bond falls. But we have discussed it in the last video on bonds, that whenever the price of the bond falls, okay, whenever the price of the bond falls, the return on the bond, the yield of the bond goes up. Okay, so the return on the bonds will rise, yes, but the price of the bond will fall. And this also shows that there is an inverse relationship between interest rates and and the bond prices. Why have the prices of the bonds gone down? Because the reduction in money supply has ratcheted the interest rates up. So interest rates are up, prices of bonds are down, return on the bonds are high. This will now have an impact on the capital goods market. high interest rates have an impact on investment. Okay, what's going to happen now? Uh, the people, the investors, people who want to invest in long-term durable assets, people who want to invest in businesses, new factories, they are going to find that that borrowing has now become very expensive. So they are going to borrow less. But simultaneously, there's going to be another thing. There are investors who move their money very fast between countries that are offering higher or lower interest rates. Okay, so let's say in India the interest rates are low, and in Pakistan the interest rates are high. So what's going to happen? Some people with the money and the ability to move the money quickly from India to Pakistan want to take advantage of that interest rate differential. They are going to move their liquid assets very quickly from India to Pakistan just to take advantage of that high interest rate. This money that moves very quickly from one country to another country so that people can take advantage of the change in interest rates, increase in interest rates, this money is called hot money. Please do keep in mind this money is called hot money. So, hot money will move inside Pakistan. But in order to move into Pakistan, what's going to happen? They are going to sell the Indian rupee and they're going to buy the Pakistani rupee because they can only invest in Pakistani rupee in Pakistan. So, what happens now? There's going to be an appreciation of the Pakistani currency. There's going to be an appreciation of the Pakistani rupee because now more Pakistani rupee is being demanded in the international, in the foreign exchange market. More Pakistani rupee is being demanded. The value of the money will rise. Assuming that Pakistani goods are sensitive to price, this will lead to demand for Pakistani goods is sensitive to price in the international market. This will lead to a reduction in net exports. The net exports will fall. So, what has happened now? Because of the increase in interest rates, consumers in Pakistan have decided that they will consume less because maybe they want to take advantage of higher interest rates by putting money in the bank. So, consumption in Pakistan will fall. Investors who are investing in long-term durable assets, they find interest rates too high to make investments, so investment will fall. And the net exports will also fall because of the appreciation of the Pakistani currency. So what's going to happen overall? Aggregate expenditure and aggregate demand both are going to fall. Okay, and that means that there's an overall contraction in employment. When aggregate demand falls, employment will also fall. Prices will also fall, the inflation will go down, but national income will also fall. So, just by now, look at the money market, just by changing the money supply, the central bank has had an impact on the entire economy. Okay, and this impact has been transmitted, it has moved from the money market to the bond market to the capital market to the goods market. All right, and the reverse is also true. The reverse is also true. If the government wants, or if the central bank wants to have a positive impact, then what will happen is they are going to increase the money supply. Okay, let's look at this. Let's look at this diagram. It shows the impact of the increase in money supply. So this will clarify things a bit further. Look at this diagram. The money supply increases. Okay, when the money supply increases, what happens? Interest falls. Okay, interest rate falls, that has an impact on the capital market as well. When the interest rate falls, there will be more investment. Why? Because now it is cheaper to borrow money for the investor. So investment will increase from I not to I1. That's the second diagram from the left. We are moving from the diagram from the left. On the left, we have this diagram, this one, where money supply increases. Then we move to this will lead to reduction in interest rates, which will lead to an increase in investment. This will in turn have the impact of increase in aggregate expenditure. Why? Because this higher investment is going to lead to higher employment. This higher employment will lead to higher aggregate expenditure in the economy. And then this will also lead to increase in aggregate demand in the goods market, because when people get employment in the industry, they have more income to spend, and then the whole economy improves. Okay, but please do keep in mind, look at this formula here. The velocity of money and the transaction demand for money keeps is the same. So when the money supply rises here, when the money supply rises, the prices also rise. There's going to be increase in aggregate demand, yes, but then the prices also move from P naught to P1. All right, so I hope this is clear. The monetary transmission mechanism and the transmission theory. So you can go over it once again. It's very straightforward, very simple. Go over it, and if you have any questions, then you can always leave it in the comment section. All right, thank you very much indeed.